Hi, good evening, ladies and gentlemen. So, thank you for joining us once again this evening. So, today our session is on ETF China A shares. If you are someone that's interested in ETF, interested to look at the China market, but you still want to stay in the Bursa market, this is definitely suitable for you. So, stay until the end. So, today we have with us Inche Kamal, Fund Manager of Value Partners, the person who is responsible for the research and portfolio management of Value Partners. Hi, Inche Kamal. How are you doing today? Glad to have you here again.
Hi Don, yeah. It's good to be here again, and thanks
Yeah,
to you and Malacca and the M Plus team for inviting me to be here.
yes, we're definitely glad to have you here as well. And the last round we did in BM, Bahasa Malaysia. And it was quite a good response that time. So to the audiences, if you want to view it in BM, you guys can check out on our Facebook page as well or our YouTube page. Okay, so today's session is a bit more special. We will be giving a special prize to the winner at the end, touch and go reload. So do stay tuned until the end of the quiz and make sure you listen clearly because who knows the answer is in plain sight. So if you are a top fan, do participate because you will get the grand prize as a top fan. And for those who are not a top fan yet, don't worry, you guys can also win the prize by sharing this video out and also answering the quiz at the end. Oh yes, I've forgotten to test out my mic. If you guys can hear me clearly, please type yes in the comment section below. If you guys can hear me, type yes. So let's view the question. Let's have the quiz on the screen. Okay, so what is the stock code of Value Partners DJ Sharia China A Shares 100 ETF? Okay, is it 838, 800, 824, 833? I'm not sure. You need to find out. So, okay, I think everyone can hear me quite well. I see a lot of yeses, a lot of response here. So, before we start, maybe a bit of a preview on today's agenda on what they will be going through.
All right. Give me a minute. Let me share my screen here.
Yeah.
All right. Can you see the?
Yeah, you can see this.
All right.
So we're learning about China A shares today.
Yeah, so basically, I think today I'm going to talk more about how to enhance your investment portfolio with China A shares, and very specifically using our recently launched and listed Sharia China A shares ETF. Yeah.
Okay, great. Sounds like it's gonna be a lot of content tonight. And if you guys have any questions, please drop it in the comment section, and Inche Kamal will be more than happy to answer them at the end of the session. And well, let's not waste any more time. Inche Kamal, the floor is yours.
Okay, thank you, Don, and thanks again the M Plus team for inviting me to be here. Okay. All right, I think so. Before I start, I think I'll just like to reiterate that Bursa Malaysia actually is running a program called the Bursa Malaysia ETF Cashback from 2nd of August until the 30th September. So it's basically left about another week also to go before the program ended. For the participant, you can stand a chance to win the 100 ringgit touch and go e-wallet reload pin. If you invest in either the ETF, the plain vanilla ETF, or the LNI ETF. So please visit the Bursa Marketplace for more details about this cashback program and the full terms and conditions applied. Okay, so before I start, let me just put up some disclaimer. I know it's a bit lengthy there, but I think the key point that I would like to highlight here is basically for you guys to note that all the materials used in this webinar is for educational purpose only, and should not be used as an investment advice. If you need any investment advice, please seek your trusted licensed investment advisor. Yeah. Okay, so before I start, allow me to provide some background of Value Partners. So Value Partners is one of Asia's most established asset managers with AUM of about 11.5 billion US dollars across wide-ranging asset classes. This is from equities, fixed income, alternative asset, multi-asset portfolios, and the quantitative investment solution, which includes the ETF. We are, in terms of the investing principle, we are basically you can view us as a temple of value investing, and at the same time our specialties or our focus is more towards Greater China and Asia ex Japan investment. The company is headquartered in Hong Kong with offices in Shanghai, Shenzhen, KL, Singapore, London, as well as the rep office in Beijing to provide localized research as well as client servicing. And also, please do follow our Facebook page, Value Partners Malaysia, or our Twitter page, Value Partners My, for more information or any news or insights about the current investment trends. Okay, so I think before I talk further into our product, let me just do some refresher about ETF. So what is actually an ETF? So an ETF is a basket of securities wrapped as a single financial product that can be bought and sold on the stocks exchange. So what does this mean is that ETF is basically a hybrid between mutual funds as well as shares. Similar to the mutual funds, an ETF contain a basket or actually a number of securities in it. And like shares, it can be traded on the stocks exchange. So how does ETF works? So normally ETF, when we talk about ETF, probably it's more skewed towards a passively, a passive ETF which tracks a benchmark. So normally for ETF that seeks to track the performance of a index, which is the benchmark, normally the ETF will replicate the index based on the index composition or its risk characteristic. So I think if let's say there's an ETF that is tracking FBMKLCI, they will try to actually mimic the weightage of each constituent in the FBMKLCI, and thus it will be this ETF will then be traded on the stocks exchange, thus bringing the best of both world of stocks as well as index fund. So what are the key features and key advantages of ETF? So I think the first and foremost, the one of the key advantage of ETF is the transparency. So what you actually what you see is actually what you get. Compared to mutual funds, you can actually get a full transparency on ETF constituent performance versus benchmarks, as well as cost on a frequent basis. So for ETF, normally all this information are available either via the ETF issue website or through through Bursa's website as well. At the same time, ETF is provide an ample source of liquidity. I think first and foremost, you can see that the liquidity in the form and measured by the secondary market trading volume. But at the same time, you can, there's more liquidity in the form of the primary liquidity through which it is based on the creation and redemption process. One thing to note is that ETF is an open-ended fund. That means the size of, the fund size of ETF can actually vary depending on the demand and supply. So as more investors wanting to buy the ETF, they can go directly into the primary market to do a creation. Thus, the size of the ETF fund will also increase. Hence, that is why we say that there's an ample source of liquidity for ETF, and it's not just based on the on-screen liquidity. The third one is basically on the diversification. So, like I mentioned earlier, in the definition of ETF itself, it is a basket of securities. So when you buy into a single ETF, you are actually buying into a basket of securities. Thus, it provides you the immediate exposure to a different set of securities or sectors, thus providing investors with the diversification benefit through just a single trade. And the fourth one is basically ETF is a cost-effective tool. So for a passively managed ETF, we can see because there's a lower turnover of the ETF, then there's a lower management fees as well. And at the same time, the last and but not least is basically the flexibility and accessibility of ETF. Because ETF can be traded throughout the day during the market hours, it gives investors the flexibility of buying on day one and sell it even on the day two or even on the same day. So yeah, I mean, these are all the key features of ETF. And I think I would like to elaborate more on the diversification part of the ETF. So we know that there's a lot of literature that actually shows that 90% of variation in return is attributed to the strategic asset allocation. Uh, so I think that there's a different literature or academics that saying that the range actually differs from 85 to 95% of the variation in return is attributed to the asset allocation. What does this mean is that most of the performance of your portfolio normally, I mean, about 85 to 95% is, I mean, can be explained by the market that you are selecting. Only about 5 to 15% of the variation of return is coming from things like security selection and market timing. So this clearly shows the importance of having exposure to a particular market, which is going to determine the bulk of the return of your portfolio. And at the same time, as ETF comprise a basket of securities, the non-systematic risks are virtually eliminated from investors' portfolio. So what does this mean is that because you are buying a basket of securities, you are basically eliminating a single stock risk. Let's say if we are saying we saw that some of the companies in Malaysia have some ESG issues. So let's say if you are putting all your eggs in one basket into that company, then you are actually exposed to the risk of that particular companies. So by buying into ETF, which comprise a basket of securities, you are actually diversifying those risks away. And I think last but not least is the ease of access to foreign investment. So by buying into an ETF with a foreign underlying, but it is traded on Bursa, you actually can get immediate and hassle-free process for foreign exposure. So what does this mean is that you don't really need to open up a foreign brokerage account or foreign currency account to get access to this foreign underlying asset. You can do it through Bursa using a ringgit asset. Okay, now we talk about the China A-shares. So what is A-shares? So when we talk about investing in China, there's a whole range of different assets or share class that we can talk about. I think generally investors are more familiar with the H-shares and red chips that is traded in the Hong Kong Stock Exchange, or even the American Depository Receipts or the ADR that is traded in the US. And these two are actually categorized as the China offshore markets. Meanwhile, A-shares is basically a mainland Chinese companies incorporated in mainland China, and then it is traded either through Shenzhen Stock Exchange or the Shanghai Stock Exchange, whereas the trading currency being used is the yuan. So that is basically the definition of A-shares. Historically, China A-shares were only available for purchase by mainland citizens due to China's restriction on the foreign investment. But over the years, we can see that Chinese authorities have been highly active in liberalizing the markets, particularly in the past 5 to 7 years. This initiative include starting the Stock Connect program in 2014 as well as 2016. At the same time, they also removed the quota limits for the qualified foreign institutional investors, the QFI, as well as implementing new laws to enhance corporate disclosure requirement and investors protection. So if we look at the chart on the bottom left there, we can see that the number of H-shares companies listed is about 285 with a market cap of about $900 billion. Whereas I think ADR, there's about 158 companies listed as an ADR with a combined market cap of about 2.3 billion US dollars. But if we look at A-shares alone, we are talking about slightly more than 4,000 companies with a combined market cap of $12.6 trillion. So this can, from this you can clearly see that by having an A-shares into your investment portfolio, you can actually widen the opportunity set for yourself to choose and pick from. Compared to just buying the H-shares or the ADR. And at the same time, since the start of the Stock Connect program, we can see that there's a continuous inflows into the A-shares itself. And even during the turmoil in recent months on the China market, we can see that foreigners continue to pour in money into A-shares, with the net inflow between June and August totaling up to $8.3 billion. And I think just like I mentioned before, despite the unnerving market environment that we can see in the past few weeks and even months, A-shares has performed relatively well against other China share classes indices over the past 1 year. So if we look at the chart there, the A-shares, which we use the CSI 300 as a proxy, actually outperformed the others like the Hang Seng China Enterprise Index, which is a proxy to the H-shares, red chips, and P chips. As well as it outperformed the MSCI Overseas China, which is the proxy for the ADR. So we can see that despite this unnerving market environment, A-shares still managed to perform relatively well. Okay, now we go back to the big question on why China. I think so when we talk about China, we need to understand where does it stands on the world stage, and at the same time appreciate the journey that they undertook to be where they are now today. So if we look on the graph there, we can see that China is the second largest economy in terms of the GDP, just behind the US. While the gap in terms of real GDP between US and China is still significant at about 1.5 times. I think as of 2020, we are seeing that the gap continue to narrow since the since the 2010. And going forward, if we extrapolate the trajectory growth of China versus US in the next 10 to 15 years at around 4.5% to 5.5% annual growth, China's GDP is set to surpass US to become the largest economy in the world sometime between 2030 to 2035. And I think just to add, consensus is actually looking at China's GDP to grow somewhere between 8 to 8.5% in 2021 alone. And this is the highest level we are seeing in the past 10 years. So what will be the driving force for China's growth in the coming decade? So to understand this, we need to take a look at the key highlights of China's 14th five-year plan. Of which the two key focus of China's 14th five-year plan includes to achieve sustainable, balanced, and high-quality growth, and at the same time to increase the middle class population. And these two will be achieved via the 6 pillars of urbanization, the focus on green economy, focus on the domestic circulation, tech localization, moving up the value chain, as well as continuously opening up their trade and investment opportunities. So as stated in the five-year plan as well, one of the key focus is to increase the middle class population, and this is pretty much has to do with consumption. We know that consumption made up about 54% of China's GDP, which is still lower than the level seen in developed economies, which range between 70 to 75%. And with globalization is actually taking a step back in recent years, and the world has shown some level of hostility towards China, the government has seen prioritizing the domestic consumption as a way to deliver a more sustainable growth. So this is where China's 500 million middle class population plays an important part. And to provide some perspective, this is equivalent to roughly about 1.5 times the size of US population. So you can imagine the growth potential coming from this higher domestic consumption. So decades of economic liberalization have delivered a tremendous wealth, creating the middle class population of 350 million, with the number is projected to reach 500 million by 2025, as you can see in my previous slide. At the same time, I think according to Credit Suisse, the top 1% in China actually controls about 30.6% of the country's wealth. And this is up from the 20.9% we are seeing 2 decades ago. So from this we can see that the income divide between the rich and the poor is widening in the country, as shown by the increase in the Gini coefficient over the years in the chart there. While this issue is not specific just to China, the effect of economic inequality on social stability is of a major concern to the government. So this is where the common prosperity, which has been mooted since last year, come into play. So what is this common prosperity, and how will it shape the future of China? So basically, common prosperity is an inclusive growth strategy that seeks better governance and more balance in the economy, so that everyone have access to the same opportunity to be wealthy. So in other words, it is to better divide the pie on the basis of making the pie larger. It should not be misconstrued as a form of egalitarian, or something like a Robin Hood kind of wealth redistribution, but rather with the goal of trying to reduce the inequality in a more structured manner. So how do they plan to achieve this common prosperity? Uh, so this include the plans to expand the proportion of the middle income group by increasing the earnings for those in the low income groups, trying to improve the market competition and crackdowns on practices and loopholes that may disrupt social stability or widening inequality, as well as strengthening the social welfare schemes. Okay, so now we talk more about the China A-shares again. So despite being the second largest stock market globally, A-shares is still underrepresented in the global portfolio, with A-shares represent less than 0.22% in global equity fund holdings. At the same time, if you look on the metrics on the right there, A-shares actually exhibit low correlation against other major markets at between zero point 0.4 to zero point 0.5. And we know that any assets with a low correlation is generally a good addition to investors' portfolio. So if we combine the mismatch between the size of China onshore markets against the current level of fund holdings, together with its low correlation, we truly believe that A shares as an asset class provide a compelling investment opportunities for investors due to the diversification benefits, as well as room for the first mover advantage. At 2019 was actually a monumental year for and the start for a greater inclusion for A shares, as index providers such as MSCI, FTSE Russell, as well as S&P Dow Jones raised to add weight to China A shares, potentially giving rise to unprecedented inflows into A shares itself. And at the same time, A share market, which has been traditionally a retail market, has seen continuous and growing participation from institutions and foreigners, while the current ownership levels indicate growth potential in the coming years. Okay, so this is some of the house views on what we believe is going to be China's new economy. And because of that, we believe A-shares is actually a good representation of these new economic drivers. So among them, I think the first one is the consumption upgrades. So like I mentioned, with the expected growing middle class population by about 500 million by 2025, this is going to actually drive the consumption upgrade due to the rising middle class population, surging household income, as well as the urbanization. At the same time, I think due to the census that was done earlier this year, which shows that China's aging population is rapidly increasing, this demographic transition, the regulatory revamp, and sector consolidation, as well as increasing global competitiveness, remain to be a positive drivers for China's healthcare sector. And I think last but not least is on the tech itself, with the long-term opportunities of the sector driven by growth of connected IoT devices globally. So these three sectors of segments is what we believe is going to be China's new economy that is going to drive China's growth in the coming decade. But of course, challenges, I mean, we can see that in recent weeks, in recent months, the challenges persist in the near term. I think for the first one, while recovery was robust in China post-pandemic, we can see that there's a sign of moderating growth for China. If you look at the GDP, the first quarter GDP was about 18.3%, whereas the second quarter it is slowing down to about 7.9%. And at the same time, we are also seeing the manufacturing PMI actually slowing down from the high of 51.9 in March to about 50.9 in June. And at the same time, we are also seeing a slowdown in terms of export, as well as investment year-on-year growth. But I think the key point to note here, despite this sign of slowing down, there's ample ammunition for the central banks and the government to actually try to boost the market. And at the same time, I think we can still see the consensus is still looking at about 8 to 8.5% growth for 2021 alone. So I think there's a lot of buffer or I mean a lot of buffer before I think before the central banks or the government has to come in to boost the economy. At the same time, while regulatory changes have made the market more volatile in recent months, we view that these reforms are in line with the government goals of achieving the quality growth as well as the common prosperity that we mentioned earlier. So we believe that the regulatory crackdown in sectors like healthcare, property, education, as well as internet and e-commerce is something that is going to be a short-term pain, but is going to be a long-term gain for the economy and the people. And I think last but not least is on the potential resurgence of COVID outbreaks. So I think earlier this year we can see that there's the concern of the COVID outbreak in China, but I think due to the zero tolerance policy of the Chinese government, they managed to bring down the numbers very fast, very quickly. But with the looming holidays such as the Golden Week in the early October, I think there's a potential risk that there's going to be another COVID outbreak. But I think worry not because of the zero tolerance policy of the government. It is we can clearly see that they I mean it will be resolved very quickly in terms of the COVID. All right, now we talk more on the product that Value Partners launched and listed, which is the VPDJ Sharia China A-Shares 100 ETF. So among the key information of our ETF, so VPDJ Sharia China A-Shares 100 ETF is the world's first of its kind, and it was launched on the 12th of July and subsequently listed on the main market of Bursa Malaysia on the 28th of July 2021. So the stock code is 0838EA. And it is a ringgit counter. And if you are more familiar with Bloomberg Terminal, the ticker or the identifier is CH100RMMK equity. Okay, so the benchmark that we are using is the Dow Jones Islamic Market China A-Shares 100. And the replication strategy or the style of this ETF is a full replication, meaning it is going to be a passive ETF tracking the benchmark. So as of the 30th of August 2021, the closing price stood at about 1.94 ringgit, with average daily volume traded since inception is about 66,691 units, whereas the NAV per unit as of 30th August is about 1.8661 ringgit. So when we develop this product, we try to tackle these three key areas, which is the geographic focus on China, because we want to tap on the growth of China, and at the same time we want to leverage Value Partners expertise on both the China and A-Shares. At the same time, as I mentioned earlier, A-Shares is very underrepresented in the global portfolio. And in terms of the thematic consideration, we added a Sharia overlay into our ETF. This is, I think, to provide access to all group of investors. So not just the Sharia investors, those that can invest in a conventional fund also can actually invest in our ETF. And I think due to the function of Sharia screening as well, the resulting composition of the ETF and the index actually focuses on the new economic drivers, with a focus on sectors like the healthcare, IT, as well as consumption, as I mentioned before. Okay, so the benchmark that we are using is the Dow Jones Islamic Market China A100. So the benchmark designed to measure the 100 of the largest China A-Shares companies that pass rule-based screens for adherence to Sharia investment guidelines, and is adjusted for the foreign ownership limits. So because this is a Sharia index, so it follows the DJIM methodology, of which it has both the qualitative screening and the quantitative screening. So for the qualitative screening, it excluded companies that have high exposure in sectors like alcohol, tobacco, pork, conventional financial services, entertainment, weapons, and defense. And in terms of the quantitative screening, it excludes companies that have high level in debt, cash plus interest bearing securities, as well as account receivables. So the constituents are weighted by their float adjusted market cap, and it is rebalanced every quarter. All right, so multiple factors were taken into consideration to ensure the robustness of the underlying index. So when we tried to develop the ETF, we actually look at different China onshore Islamic index as well. So apart from DJIM China 800, there is other like MSCI China onshore Islamic as well as FTSE Sharia China E50. So if we look at the total return of these three indices, which stretch as far back as December 2016, we can see that DJIM China 800 actually outperformed the other two by quite a huge margin. And one of the key reasons is because the differences in the methodology being used. So like I mentioned earlier, when it comes to the quantitative screening, where we have the debt ratio, we have the cash ratio, and we have the receivable ratio. So for the DJIM China 800, the denominator being used for these ratios are the market cap, whereas for MSCI and FTSE, they are using the total assets as the denominator for this quantitative screening. So what we found out is that the total asset-based index actually discriminates against tech and services sector, which operates on asset-like business models. And this is one of the key reasons why it severely underperformed the market cap-based index like DJIM China 800 in recent years. And at the same time, due to the function of the Sharia screening, or the quantitative Sharia screening, which have the, especially on the debt ratio, our Dow Jones Islamic Market China 800 is less susceptible to the challenging environment compared to other China-related indices. So if you can see that the Sharia A shares actually outperform the conventional A shares, which we use the CSI 300 as a proxy, as well as it outperformed other index such as the S&P New China X A shares, which predominantly invest in H shares as well as ADR, as well as it outperformed the FTSE China 50, which are predominantly the H shares. Okay, so our DJIM China 800 is actually a good proxy to CSI 300. If we look at the correlation, it's about 0.89 and beta very close to 1. But it also offers a unique differentiation proposition. If we look at the holding characteristic of our index compared to the CSI 300s, our DJIM China 800 are skewed towards profitability and quality, as shown by the higher ROE and higher ROE of our index compared to the CSI 300. And if we look at the performance, 1 year, 3 year, and 5 year performance, our DJIM China 800 managed to outperform the CSI 300 in all the three periods mentioned there. Okay, so now we take a closer look at the top 10, top 10 between our index as well as the CSI 300, as well as the sector composition between our index and the CSI 300. So due to the function of Sharia screening, DJIM China 800 virtually have no exposure in the financials and the real estate sectors. So we know that both financials and real estate sectors in CSI 300, along with the high leverage SOEs, were the main drivers of China's old economy that we've seen in the early 2000s. So with the absence of financials and less focus on SOEs and real estate, DJIM China 800 are skewed towards the new economic drivers with high exposure in sectors like IT, healthcare, and consumption, which again echo what we have been talking about China so far. And at the same time, I think I would like to add, I'm sure that some of you are quite familiar with what's happening in China in regards to this company called the Evergrande, which is one of the largest property companies in China, and it is dubbed the world's most indebted property developer in the world. So the beauty of this Sharia index, and like I said, because of the debt ratio threshold of the quantitative screening, so definitely this kind of company will not be included into the index. So that is why we can see that virtually there is no exposure in real estate in our index. So if So if the questions on whether or not Evergrande actually directly affect our ETF or our index, the short answer is no, because we have no exposures to direct exposures to the real estate sectors. And at the same time, financials, which are also excluded from this ETF, is also one of the key sectors that have exposures to through this Evergrande saga. So definitely that one is also excluded from our ETF. So the short answer is that our ETF doesn't really have exposure to both the financials and property, which has been plaguing the Evergrande issues that we are seeing in the news quite recently. Okay, so at the same time, we actually have we actually created these top 10 fact sheets of companies within the within the index. So what we found out is that each of each one of these companies are actually the market leader in the segments or the sectors that they are operating in. So take CATL for example. They are basically the EV battery manufacturer, the largest both in China as well as in the world. And in terms of the valuation metrics, we can see that it also echo what I mentioned about the skewness towards profitability, where we can see that the ROE for CATL is much higher compared to the peers in the sector. And at the same time, due to the quantitative Sharia screening, these companies actually exhibit stronger balance sheets, where you can see that CATL has a is in a net cash position compared to the sectors, which is mostly in the net debt, which is in the net debt position. And this kind of traits can be actually seen in the other 9 companies in the top 10 as well. Okay, so next, how to use this ETF to enhance your portfolio. So there's a various approach to add ETFs into your portfolio. So I think the first one is a more direct, so diversification through a single ETF. So like I mentioned, our ETF consists of 100 largest China A-shares companies. So by buying into our ETF, you can actually get a direct access and immediate market exposure to the underlying index. And this diversification benefits can be achieved through this single ETF because you're actually seeing 100 names within the ETF with a wide-ranging sector composition, where you have the healthcare sectors, we have the IT sectors, industrial, consumer discretionary, as well as materials and others. And at the same time, I think if you are more creative, you can actually do a global ETF portfolios just by combining the low cost and different market exposures of the ETF to create a global portfolios. So right now in Bursa, we can see that there's a few ETF which with the foreign underlying assets, but can be traded using ringgit. So you can use all these ETF to create the global ETF portfolios. And at the same time, you are able to incorporate your own view through tactical adjustment on asset allocation. So let's say if you are less bullish on ETF China, you can actually reduce the ETF China, whereas if you are more bullish on Malaysia, you can actually increase your allocation towards Malaysia and vice versa. And I think last but not least is basically to combine your ETF with the domestic single stock portfolio. As I'm pretty sure that a lot of investors, especially the retail investors, have a very concentrated domestic single stock portfolio. So we know that Malaysian market hasn't been, had its fair share of challenges in the past, I think, 2-3 years. So if you combine ETF with this domestic single stock portfolio, you are able to diversify away from the single country exposure and home market risk. And at the same time, you are able to potentially generate alpha or even reduce risk through this portfolio combination. And like I said earlier, the operational ease through the ringgit denominated foreign underlying asset, which means that you don't really have to open up a foreign brokerage account or foreign currency account to trade foreign underlying asset. You can just do it with the ETF that is listed on Bursa. At the same time, I think this ETF can be accessed through the primary or secondary market. So from the secondary market, normally it's based on the demand and supply of which the price will be determined. At the same time, if let's say the investors such as the high net worth or even the institutional investors which wants to come in the big way, they can actually go straight to the primary market to do operation or redemption for ETF. At the same time, ETF, you can either do a direct approach, you can take a DIY approach and instruct your brokers such as M Plus to execute trades via the online trading platforms, or you can actually buy the ETF through robo advisory platforms. I think we have a few robo advisories in the Malaysian market right now that you can access this ETF from. And I think last but not least is I think I would like to reiterate again the Bursa Malaysia ETF cashback program that is running from the 2nd of August up until the 30th September. So investors can stand a chance to win 100 ringgit touch and go e-wallet reload pin. But please visit Bursa Marketplace for more details and this about this cashback program and the full and terms and conditions. Okay, I think that's all from me. Over back to you, Don.
Okay, thank you. Very interesting presentation. I just learned a lot more about this China A shares as well, and that there's over 100, right? Based on the name, it is 100. There are 100 shares in it.
Yeah.
Am I correct? Right. Yeah. Just wanted to make sure I got it correct. So I'm sure the audiences learn a lot, and because we can see there are some questions in the comment section. But before we move on to the Q&A, let's put up the quiz once again for the benefit of those that have joined later. Okay, so what is the stock code for Value Partners DJ Sharia China A shares 100 ETF? So 0838, 0800, 0824, 0833. So do put in your answers in the comment section below, and you have to be a top fan or sharer of this video to be eligible to be in the running for the prize. So because I saw some that answered, you guys still haven't shared the video, so please do share the video quickly as my team is still picking up on who are the winners. But before we proceed to that, let's get on to the Q&A session first. Okay, first question is from myself, is that who would you say, what kind of person would be suitable to trade for this China A shares ETF? Like, do you target a specific market?
I think we don't really have like a specific target, but like I said, this ETF is accessible to all type of investors. So be it whether you are Sharia focused investors or even a conventional investors that just want an exposure into China A shares market. So like I said, I think A shares is very underrepresented in the global portfolios, and I think we can still see that inflows into the China A shares keep pouring in despite the challenges that we can see in the market. So I think it is a good opportunity for every investor, every type of investors to actually share this opportunity lah. Yeah.
Okay, understand. Okay, there's one question here is that do you have, I think this is referring to inside the ETF, there's 100 share, this doesn't sound surprised. How often does the list change? Does it change? Do you swap between different shares or whatsoever?
Okay, so we follows the benchmark. So normally the benchmark is rebalanced every quarter. So this is the rebalance is done every quarter. Not just to just a normal rebalancing, but at the same time to exclude the stock that is no longer Sharia and then to include those that are Sharia. So this rebalancing occurs 4 times a year, every quarter. So this is this list changes like every 4 times in a year. Yeah.
Okay. So other than rebalancing on the Sharia only, does it change other than that? Is there any other criteria for the rebalancing?
Okay. There's some I would say exceptional cases where we have to do ad hoc rebalancing. And I think one of them, I think if you're familiar, since the start not really the start, since towards the end of actually Trump administration in the office, they actually imposed some sanctions into Chinese companies.
Yep.
And if, let's say, these companies fall under the sanction of the US administration, then we have to actually remove it. Depending on when it is removed from the index, then we have to do some ad hoc rebalancing.
I see. I see. So you guys have a team for that, and also there's one person asking. Fujin here is asking, who is the market maker for this ETF?
So the market maker, I think one of them is Melaka Securities,
Yeah.
and yeah. So and then the other is Kenanga.
Mhm.
Yeah, and then we as the ETF issue has been working with them very closely to ensure that there's enough liquidity in the secondary market. Yeah.
Okay. 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 John here is asking, does this ETF pay a dividend?
No, the ETF doesn't really pay a dividend. I think largely because if we look at the composition or the characteristic of the ETF and the index, it is skewed to. If you look at the valuation, it is skewed towards a growth kind of style. Whereas where the constituent doesn't really pay much dividend. If you look at the index dividend yield at about 0.8%, so that is why we don't really pay out dividend. So we think that this is more on the capital gain kind of ETF.
Okay. There's one person asking, are there any ADR share in this ETF?
Yeah, like I said in the earlier the early part of my presentation, it clearly shows that our ETF is just focusing on A shares with no exposures in ADR, no exposures in the H shares. It's just purely purely A shares.
Okay. Okay. Okay, this is more of a technical question. How do we know whether this ETF is trading at premium or fair value? Is there a way to calculate that for the benefit
Okay.
of the audiences?
If we look at the Bursa Marketplace website, there's this thing called the IOPV. So the IOPV is basically the intraday NAV of the ETF. So normally, what investors should do is try to see what is the prevailing price at the moment trading on the secondary exchange, and look and compare it with the IOPV of the ETF. Then the differences is basically the premium discount to the NAV lah.
So they can get this info on Bursa Marketplace, is it?
Yes, it is available in the Bursa Marketplace.
Okay, so if you guys want to know about the premium or fair value, you guys can visit bursamarketplace.com for more details on it. Okay, we still have quite a few more questions. Are there any management fee charged for this ETF?
Yeah, the management fee is up to 0.6% per annum.
Okay. Okay. Okay, interesting question here. With the policy announcement coming from China, will this be a negative view for China A shares compared to Hong Kong shares or ADR?
Okay. Okay, I think when we talk about the regulatory crackdown, I don't know whether it is by coincidence or it is actually a targeted one. But we can see that the sectors or the names that actually affected are those that is traded offshore. And that is why I think if we look at the performance return that I showed earlier, the A shares actually the A shares index are more resilient and perform relatively better compared to the ADR and the A shares.
Mhm.
Yeah.
So it's what it was, to put it simply, is like the local China ones are not affected or not affected much by it.
I think directly it is not affected by this regulatory crackdown, but I think, of course, the sentiment, the negative sentiment,
Yeah.
actually have some impact on the market. So this is where
Yes.
probably the effect is coming to the A shares itself. But definitely, I
Okay.
think we're not seeing any direct impact from this negative news. Yeah.
Okay, that's good. That's good to know. Let's see. Okay, we have one here. Being that this is a very new hybrid instrument, can we expect ETF to have a better ROI than the usual unit trust that is available locally? What's your comment on this question?
I think it's okay. I'm just going to play it safe here. I think I'm just going to say that ETF is a low cost investment tool as compared to the normal unit trust fund. So I think from there you can actually gauge how you I mean get your ROI lah.
Yeah.
Yeah.
Oh, I see one question from Eddie. Besides management fee of 0.6, is there brokerage charges by M plus? Yes, we do have the usual 0.08% or minimum 8 ringgit charges for our brokerage per trade. Yep. Mm, There's a few questions. There's two questions. Maybe I don't know if you can answer it together. How liquid is this ETF, and also how sensitive is it against the China market?
Sorry, the first question is what again?
How liquid is this ETF?
Okay. Okay, I think the question is quite broad. So I think when we talk about liquidity, there's the liquidity of the ETF itself and the liquidity of the underlying asset, which is the 100 constituent names. So actually, we actually take steps to ensure that there's ample liquidity on both the underlying assets. At the same time, there's enough liquidity from on the ETF itself via either the exchange or even through the hidden liquidity where you can actually seek the market maker to buy ETF, or you can even go through the primary market to do accretion and redemption in a big way.
Okay.
And I think the second one, how sensitive this ETF
Sensitive.
against China market again. If you because this ETF or the index actually has a very high correlation to the CSI 300. Like I said, the correlation is about 0.89 and beta very close to 1. Of course, any volatility that is seen on the China onshore markets will have an impact on our ETF.
Okay. Yeah, I think we do not have. Well, there's one from Rose. Is it a good time now to buy this ETF?
I think that's the $1 million question, right? I mean,
Yeah.
if if I know that, I
Yeah.
already be a millionaire already.
Yeah. Same.
But I think like I said, on our ETF, given that we don't really have a direct exposures to either the Evergrande saga or even with the regulatory crackdown, I mean, you can actually see that probably this is one of the good time to actually enter the I mean buying the ETF. But again, please do your own due diligence before buying into our ETF.
Talking about the Evergrande saga, I was wondering, because you mentioned there's no direct impact to this ETF, but should the investors be prepared of any risk or any indirect impact or anything that could occur?
Okay, I think we already addressed the issue of the direct impact, which again, due to the
Yep.
Sharia screening, we can clearly see that there's no exposures in the real
Yep.
estate as well as the financial sectors, which may have a direct exposure to the property side, right? But I think that the next question is on the issue on whether I think some analysts or some market analysts are actually saying that this is probably a Lehman Brothers moment for China, which I
Mm.
think is a bit of overreacting. Uh, of course, when we talk about Evergrande liabilities, which is about 300 billion US dollars, and I think by the calculation of Goldman Sachs, that's about close to 2% of China's GDP. Of course, the size is huge, but we believe that China's system is strong enough to handle the crisis. Hence, there is no need to panic over this. And as you can see, even last week during the height of the during the height of this saga, we can see that the PBOC actually injected about 18 billion dollars into the market. So we can clearly see that both the central banks as well as the government can actually do something to actually calm the market. It's more like for them to balance between trying to calm the market and at the same time to avoid the moral hazard of this kind of thing from happening again. Yeah.
Whenever I hear moral hazard, I remember about Wall Street movie.
I know, right?
Yes. Okay. Let's see. I think there's a few more questions. There's one here asking is that would you say that China A share is superior to China A? China A Sharia is superior to China A conventional, and why? Maybe I guess everyone has their own good, but what would be the
Okay,
selling point of?
I wouldn't call it superior, lah, but
Yeah.
I think, like I said, there's always a trade-off between being a Sharia and being a conventional, right? But because when we talk about the China's in the next 5 to 10 years, where the focus is more on the new economic drivers, and our ETF is basically, basically skewed towards these new economic drivers. Hence, why we believe that is one of the investment thesis of buying into our ETF.
Okay. Understand. Okay. I think we have answered all the questions, and it's almost 9 p.m. So thank you for answering all the questions, and thank you to the audiences for asking all the questions.
Yeah, very
And
interesting question. Yeah.
yes, yes, yes. Especially the one that says can buy now or not. All right. So has anyone key in their answers in the comment section? And have you shared the video? I hope you have, because we are about to reveal the answer. Reveal the winners now. And before we reveal, Encik Kamal, can you do the honors of answering the question?
Okay, so the answer is 0838EA. So A.
083A.
Yeah.
You were like revealing the 4 digits. Okay, let's put the winner list up, because we have the winner list ready. So my team will be putting it up. And to the winners, congratulations and thank you for participating for the event. Okay, yeah, here are the winners. So thank you for participating. And for those that did not win this time, don't worry. We have many more webinars coming ahead. And a tip for you guys is that we have a market outlook by our head of research next week, and you have a chance to win this prize as well. And we are still planning. Maybe we might double up the price, triple the price. So tune in to the market outlook to get the price. Yep. Okay. Thank you, Inchikama. Thank you, Value Partners, for being on board with this session. We are glad to have you here and hope we can bring guys back again next time for more interesting topics on this China Asia ETF.
All right. Okay. Thank you, Don. Thank you, the M Plus team. Yeah.
Yep, no problem. And to the winners, do check your inbox on Facebook to make sure that you so that we know where to send you the prize. So do check your inbox. Thanks. Okay, I think we reached the end of the session. So thank you everyone for tuning in, and we shall see you once again next time. Thanks.